Welcome to What's Not Priced In, a weekly investor podcast by Fat Tail Investment Research. In a world of confusion and rapid change, experts Kirill Prakapenka and Greg Canavan look behind the headlines to unveil the hidden opportunities within the Australian stock market. Now, let's dive into today's episode.
Wow, who saw that coming? The Reserve Bank thwarted expectations and hiked rates to 4.10%. On this episode, Greg and I focus on what this means and what the market is overlooking. We also discuss the ominous labour productivity numbers. Hint, it's not looking great for the employment rate. We then finish by canvassing Aussie banks and the threats Greg thinks the market is yet to price in. Does Commonwealth Bank warrant its premium? Watch on to find out. Hello, and welcome back to the third episode of What's Not Priced In. As always, my name is Kirill, and joining me is Greg. Hi, Greg.
G'day, Kirill. How are you, mate? Or Kirill, sorry.
That's all right.
I've only been calling you Kirill for the past couple of years, but
I think it's either or. It's either or. Now, what I wanted to say is that, as I think viewers probably already know by now, this podcast is driven by one question and one question only, and there's what has the market priced in, and it sure didn't price in Wednesday's 25 basis point hike by the Reserve Bank. I think 21 of 32 analysts polled by Refinitiv expected the RBA to keep rates steady. I think market traders pinned the chance of a hike at about 35% leading up to the announcement. So clearly the market was taken aback. It was a bit surprised. But now the analysis turns to what the market is thinking now. What is it pricing in now, given what the RBA has done? And what is the market not pricing in? And for that, I'm going to turn to you, Greg. Before I start, actually, did you expect the RBA to hike by 25 basis points?
No, I didn't. I think when we chatted last week, I can't remember exactly how we couched it, but I pretty much said, look, I don't think they will. And sometimes you have that opinion because you think, okay, what am I seeing out there in the market? How am I seeing stocks trading? And do I think the RBA should be raising again? And we talk about this maybe in a bit more detail. Given that they've already raised rates so far and so fast, they could probably afford to sit back and wait. They clearly didn't do that. I think I saw a headline post the meeting saying Governor Lowe has run out of patience with inflation and wants to act. And my initial reaction to that was, well, it takes time for interest rates to work. You can't run out of patience and just start pressing the button faster, hoping that something's going to change. It doesn't work like that. And we had a discussion afterwards, and I said something like, let's assume interest rates act with roughly a 9-month lag in terms of their effect on the economy. If that's the case, and we don't know what the lagged effects are, there's lots of different studies out there, but there is the general opinion is that interest rates act on economic activity with, as Milton Friedman said, long and variable lags. So let's assume that's 9 months. There's still something like 200 basis points of rate rises to still flow through the system. So my view was that the RBA can afford to sit back and wait and see, because there's clearly evidence of things cooling off. And ironically, we got it a day later when the ABS released economic growth data. Bear in mind, that was economic growth from January to March, when a lot of the interest rate effects still were flowing through, but hadn't had the full impact. And that showed that the economy is growing quite slowly. It showed that labour productivity is very, very poor. So there was a lot of evidence come through the day after the rate rise to show that the economy is already slowing. And now we've got more monetary tightening flowing through the system. And as you said, that wasn't priced in. I looked at right on the dot of 230, the stock market tanked, bond yields shot up. It wasn't priced in at all, and rightly so. I think, and this partly comes back to RBA signaling, right? Like one of the things that central banks have done for the past decade or so, or even longer, is communicate quite effectively what their monetary policy decisions are going to be in order to not surprise the market.
Yeah.
And that clearly surprised the market. And the RBA has been surprising the market for the past few months at least. So their communications aren't great. And you could say that, okay, inflation's quite persistent and sticky, and therefore they have to act, in a quite aggressive manner. But as I say, that doesn't take into account the lagged impact of monetary policy. So my guess is that in another 3 to 6 months' time, the RBA is going to be thinking, shit, we've tightened too much, and we're going to have to unwind this at some point, because inflation acts with a lag as well. So I think they've, in the same way that they loosened way too much in 2020, 2021, they're now over tightening and going to cause more problems. And we pointed out in the podcast last week that the yield curve was very close to inverting, and sure enough, on the day that the RBA increased rates again, the yield curve did invert. So
yeah, but I think the yield curve is now inverted, and I think the last time it was inverted was in 2008, and I think it actually first started to be inverted in, I think, June 2006, and then it was inverted for a couple of years. But maybe you can just explain the significance to viewers of yield inversion and why it's such a big deal.
Yeah, and while I do that, I'll just bring up that chart you mentioned, because I think it's a really interesting one. So here it is. Here, this is basically the 10-year yield, 10-year government bond yield minus the 2-year government bond yield. And in theory, the 10-year should be higher than the 2-year. You should be rewarded more for longer timeframes of investing. And when the 10-year is higher than the 2-year, it denotes an upward sloping yield curve, which is a normal structure for the bond market. And that suggests there is growth in the economy. That suggests that there's, a normal economy growing, in a normal way. Doesn't mean it's, growing fast or particularly slow, but just a normal structure of the bond market and a normal economy. When the yield curve inverts, it's a sign that the bond market's saying interest rates are monetary money is very tight, which will lead to a slowdown, and the longer term bond yields react to that slowdown because it's seeing less inflation in the economy. And as we can see here, this is the last time it dipped into an inverted state. So it did so, I think you mentioned, back in 2006 here, and it stayed that way all the way through into 2008. And that was a pretty good indicator of what was to come at that time. Granted, here, it's only just slipped into an inverted state, and I think it's only a couple of basis points at the moment. So it's nothing too drastic. I should also point out the US yield curve has been inverted for over a year now. And people have been predicting a recession. The recession isn't coming, but I would almost wager that the US is very close to a recession at the moment. And one thing that's propping things up is the good employment situation. And just while we're on employment, this is another chart that you dug out after the economic growth numbers came out on Wednesday. And I thought this one here was really interesting. Productivity, which is GDP per hour worked, negative for the year. So it's essentially saying that labour is becoming increasingly unproductive. And employment numbers are a lagging indicator as well. So often when the economy slows down, employers say, look, I've held on to these jobs for a certain amount of time, hoping that things turn around. It's not turning around. Things are getting worse. We're going to have to start laying people off. And the fact that labour is so unproductive at the moment suggests that we could be in for a decent increase in unemployment in the next 6 months if the RBA stays quite tight in its monetary policy. And we'll look at some stocks later, but the stock market reaction and the reaction of the retailers, I'm already seeing a lot of retailers issue profit warnings now, suggests that those rising interest rates are really hurting. So I wouldn't be surprised to see the unemployment rate pick up strongly in the next 6 months, and the RBA will be at least forced to stay on hold for a little while. So
and I think some more numbers from the latest national accounts. I think economy only grew 0.2% during the March quarter. And on an annual basis, that was 2.3%, and that was the weakest quarterly growth since the COVID-19 lockdowns in 2021. and GDP per capita fell 0.2%. And yeah, like you mentioned, GDP per hour worked fell 4.6% compared to the same time last year. I think another thing that I wanted to mention from that data dump from the ABS was that households only saved 3.7% of their income during the March quarter. And that was actually the lowest proportion of household income being saved since 2008, which is interesting because that sort of correlates to with the last time that the yield curve was inverted. But it's also interesting because savings are down despite Australians actually spending less on discretionary items. So spending on discretionary items fell 1.1%. And if you exclude the pandemic, this was the first fall in discretionary spending since the September quarter of 2019. So I think that
it just goes to show the impact that rising interest rates are having on household cash flows at the moment.
Exactly.
People are running down savings. So consumption is holding up, but it's holding up at the expense of a reduced savings rate. And when we say consumption's holding up, that a lot of that's probably being funneled into just the essentials, because the inflation in terms of just regular eating out or just staples, household shopping, that sort of stuff, has been quite significant. And if you look at the GDP, the annual GDP number in current income, so that includes the effect of inflation, the economy is running at 9.2%. But as you pointed out, it's 2.3% in real terms, which means a lot of that is inflation, and that is costs that have to be absorbed by the economy in some way. And just on that, I thought we were chatting, we were listening to the Q&A that was going on.
You weren't happy at all with that. You were quite angry.
No, I just thought, the questions that were being asked were so just so pointless. And I guess these journos are in a position where they can ask the RBA governor some really crucial questions, given what power they have and the control they have over the economy. And they were just these really softball, shitty questions that I thought, this is not giving an insight into anything. And one thing that sort of quite annoyed me was someone asked about the government and is the government's fiscal stance impacting inflation? And Lowe said, no, it's pretty neutral, and they are doing some good things. They're trying to get household power bills down. So he's actually endorsing a situation where the government is giving handouts to people in form of increased spending to lower their power bills, which then obviously frees up more of their discretionary income to spend elsewhere, instead of encouraging more supply and getting prices down from a supply perspective, which is the way the market should be working. And that way the government doesn't have to spend out of its own pocket in order to get prices down. So Lowe was actually saying that's a good thing. The government is getting energy prices down because it will lower the future inflation numbers, which, purely from a theoretical perspective, fine. Inflation's going to go down because the government's spending more money to push prices down, but we're not increasing supply. It's a very, very short-term impact. So, and then the other thing I think I would have liked to have asked, and it's another chart we've got here, which I'll just quickly show as well. And I talked about it just before, going back to the lagged impact of rate rises. Here's another great chart that you dug out during the week, and it shows the RBA rate hiking cycle since the 1990s. And as you can see in red, which is the 2022-23 cycle, has been by far the sharpest bunch of rate rises we've seen. Well past the 1994 cycle, which was pretty infamous for its effect on bond markets and equity markets at the time. And this cycle has been, as I said, by far the sharpest we've seen, well, since at least 1990, but I would say probably a lot longer before that as well. I don't have all the data, but to my mind, this is one of the sharpest rate rising cycles we've had. So there's a lot of monetary tightening still in the pipeline to come through. And no one asked him about how they view the lagged impact of monetary policy. They've alluded to it before. They seem to They seem to adhere to that. I think it was in April where they held off a rate rise, and then they've decided, no, we've got to keep going. So yeah, it would have been good for someone to ask how they think about the lagged impact of monetary policy, and how they're sort of viewing that in terms of further rate rises. And that's why, in many ways, I think his hawkish commentary was more about trying to put fear into people to say, I'm going to keep rising rates. I'm not going to let an inflation psychology get into the mindset of households or whatever it might be, rather than genuinely thinking he's going to keep raising rates. To my mind, that'd be absolutely crazy in an economy that is highly leveraged, and households are already in a lot of financial stress. And if you look at the amount of money that's that the fixed interest rates are going to reset this year, and you can see that in the shrinking of the RBA's balance sheet as these fixed, very advantageous fixed rates roll off. That was a lot to do with the term funding facility that the RBA provided to all the banks back in 2020, 2021. Their balance sheet is set to shrink by 15% this year, which means a lot of those fixed rate, and they've already started to come off, but that will continue to happen throughout the year. So you're going to see more and more households be hit with interest rate shocks. So if Lowe keeps raising rates into this situation, I just think it's madness. So I would have liked to have seen some probably better questions asked, but maybe that's why people like us never get invited to these things.
So maybe they would have asked better questions at Barrenjoey, and then he remember that whole fiasco when he got asked.
Which one was that?
I think he was going to do a presentation at Barrenjoey in front of like market participants.
Oh, that was a private event, wasn't it?
Yeah, but I reckon they would have asked some better questions.
Absolutely.
Yeah, but I think you were sort of saying that he's sort of trying to signal to the market. He's sort of waving his sword and saying, "I'm going to tame the inflation dragon," as was one of the journalists put it. And I think some of the latest data, I think, when the decision was made, traders put the probability of a further hike in July at 11%. On Wednesday, that rose to 18%. And then yesterday, Thursday, the market was implying about a 23% chance of an increase to 4.35% at the next meeting. So will it keep rising?
Hey, that's not much different. That's not much different to what it was a week out from the last decision. So who knows?
Yeah, exactly. Well, I think maybe to tie that whole discussion about the interest rate. So what do you think is the biggest thing that the market maybe is not pricing in?
Good question. I think if you look at the retail sector, I think from an investment perspective, that's where you should be looking to get interested, because I think that has started to price in a lot of pain. I'm not one for buying stocks that are sort of heavily in downtrends and being sold off, but I think that's where a lot of value is. What isn't priced in, I think we're going to touch on this in a bit more detail later on. I think the banking sector needs to be looked at quite closely, because the banks are definitely cyclical. They're definitely very, I guess, leveraged to economic growth, given that they are massively leveraged institutions themselves. So whereas they have come under pressure over the past couple of months, bank stocks are well off their highs. But if we are moving into a sharp slowdown, and the Reserve Bank either keeps raising interest rates or keeps interest rates at a high level for a good number of months, which I think they will, by the way. I think if they're very focused on inflation, and inflation is a lagging indicator, it's going to, in real terms, inflation will be a lot lower on the ground than what the numbers that they're getting and they're going to react to. So I think they keep rates higher for longer. I've said that for the past couple of podcasts now. And that is going to impact on the bank's earnings. It's going to impact on the non-performing assets. So to my mind, there's a lot that's not priced in to the banking sector at the moment. So we'll get into detail in that in a little bit, I think.
Yeah, but before we get into that segment, we'll want to talk about the stocks of the week for this episode. And yours, two stocks of the week, both fell sharply over the last, I think, couple of days, and those two stocks are Qantas and Seek. So maybe we can start with Seek because it sort of has relevance to the labor productivity we were talking about earlier.
Yes, so I thought this was interesting. Seek is a great company. I've had it on my watch list for some time, and it really just hasn't ticked the valuation box. It's just been at a price where I just think, okay, risk and reward isn't particularly favourable. So I was just sort of holding off, and quite mystified in many ways to see this uptrend, continuing on. And when the stock was reasonably overvalued, I'm thinking, okay, well, we're going into potentially a slowdown or but even a recession. Seeks an employment portal, basically an online employment portal. Majority of its business in Australia. It's got overseas operations as well. But I thought, how is this sort of continuing to trend higher? And then if you look at here, this is Monday. Tuesday, it broke down. This is on the RBA's decision, broke down below this rising trend line and continued to sell off sharply. So I've set this to a weekly indicator. Over the past week, it's down 8%. And just on the back of that chart that we showed earlier on labor productivity, to my mind, that's just a pointer to say jobs are going to go the more this economy slows down, because that's the only way that businesses can keep on top of productivity. They got to shed labor because labor is not productive. So this was a good indication on that front that is potentially going to happen. If you think about stocks, they're always leading indicators for what's going on in the economy, and the market's saying that Seek is going to be in a bit of a slowdown phase with this break of this uptrend here. So I thought that was interesting. The other one I just wanted to point out, Qantas down nearly 7% over the week. We mentioned this, I think it was in the first podcast. I just mentioned the fact that this could be a period of distribution for Qantas. And when we talk about distribution when it comes to stock prices, after a decent rise, you can sometimes get a period of volatility around the tops. And that volatility is an indication that shares are being distributed, which means that longer term holders are exiting their positions. So that's not to say Qantas is going to fall, but to my mind, there's an increasing likelihood that the share price will fall lower. And again, this weakness here was on the back of the interest rate decision from the RBA, which is the market suggesting that people are going to tighten their budgets. They're not going to fly as much. Overseas holidays might be reconsidered, all those sorts of things. And I just thought it was interesting in the context of, I read an article in the Fin Review this morning, fund managers pitching their ideas at one of these conferences, and one fund manager came out and said, Qantas is going to outperform for years to come, huge amounts of demand. They're not going to decrease their prices back to pre-pandemic levels. And sometimes the way I think about these things, not always, but when fund managers get up in conferences, everyone's human, and there's not a lot of genuine contrarians out there who are willing to stand up and pitch their contrarian ideas in front of audiences of peers and be, potentially looked at as, what's he talking about that stock for? That stock's a dog. Whereas you can get up there and talk about Qantas. Qantas has done quite well, even over the last, since the pandemic. Really, it's gone from low threes all the way up to mid sixes. So it's done really well. There's a lot going for it. There's a lot to say that, this is a dominant player in a duopoly. All those reasons you would say, okay, well, Qantas looks quite interesting. But for my mind, it has done very well based on the whole reopening theme and people wanting to travel again. That all makes sense. But here you're starting to see these signs that, perhaps this is as good as it gets for now. And the fact that the share price sold off sharply on the back of the RBA's decision this week is potentially another indication of that. So, yeah, I just thought they were interesting stocks to point out.
Yeah, I think me personally, travel stocks are an interesting in sector, because I think Air New Zealand released an update, I think this week, and it said that it was surprised by the stronger demand than usual, I think in the latest few months, and I think it said it was usually its off-peak period. And I think it's sort of now a sort of revised guidance because jet fuel prices are down, fares are moderating, but not as much, so they're still quite high. And also the demand is there that I think Air New Zealand didn't really anticipate being there. So I think it's, and I was trying to find maybe some statistics from, can international airfare almost predict or be like a leading indicator of a crunch in consumer spending, because it's such a big part of a person's discretionary budget. So I'm just really wondering, I think some travel stocks have seemed to hold up well, but surely how long can it really last if, savings are already down to 3.7%, discretionary spend is already falling. So I think some people have said that travel has been we haven't traveled for so long during the lockdowns that people are just, no matter what, no matter how much money in the bank I have, I'm still going to travel. But that surely can't
and I
last
think that's
long.
Yeah,
go on.
Well, I think it's true to an extent. A lot of that stuff, when it comes to airlines, depends on the capacity that they want to bring into the system as well. A couple of times I was flying back down to the office in Melbourne a few months ago, and the prices were just insane, and that was more to do with capacity. Yeah. They just weren't bringing capacity into the system. But potentially now with Virgin back up and running in a more organised way, they will either compete for market share or they will happily manage their capacity together to maximise profits. But I mean, it's a very cyclical industry, very capital intensive industry. There's a lot of talk about Qantas needing to spend billions on reinvesting in its fleet. So that's a huge capex spend there. To my mind, it's just a tough business to be involved in, and especially after share prices doubled, it's not something that as a value investor I get particularly excited about.
Yeah, exactly. And I think that the capacity thing is, I think, a huge determining factor in how well they've performed. I think Qantas is still operating pre-COVID levels, especially for international fares. So they're running less flights, and clearly that's helping them with their prices. But anyway, I think that's enough for me talking about travel. And now it's what everyone's been waiting for, the most important segment of the show, what's not priced in. And you've already alluded to what it's going to be about. It's going to be about the Aussie banks. So maybe you can kick us off.
Yep. No worries. Well, I thought it'd be interesting to look at the Aussie banks in depth. And when I started doing some research on this week, I was actually surprised by the divergence in some of the names. So, obviously the big four banks, Commonwealth, NAB, ANZ, and Westpac. We've got a couple of others that we'll show you as well, but they're the main ones. Perhaps it'd be best if I just give you a quick look at the charts just to show you how the stocks have performed, and put this discussion into a bit of context. So here is Commonwealth Bank. It's pretty much gone sideways. It peaked. This is very similar to the peaks in the market, really. November 21 it peaked, and then it slightly beat that in February this year. So that wasn't too long ago, actually. But and if you look at where the share price has gone since then, so there's your February peak, and we're down to so we're off about 14% in what's that? A little less than about 5 months, which is a decent fall. But pretty much the stock has gone sideways for some time. I've drawn a little line here. This is roughly an area of support, which is around about $90. And if we zoom in a little bit here, I use these moving averages just to give me a bit of an indication of the medium-term trend line. This is the 50-day moving average and the 100-day moving average. When they cross over, that suggests that the medium-term trend is turning down. And as you can see here, when the stock's tried to rally, it's rallied back up into this 100-day moving average and hit resistance. So while that's in effect, you could say that the sector's in a downtrend. This is the biggest stock, the most well-owned, the most well-loved stock in the sector. So this is Commonwealth's always an important indicator. But if you look at some of the other stocks in the sector, they haven't done well at all. This is National Australia Bank. It recently broke down below the low from June 2022 when the market really sort of panicked about interest rate rises and the impact of inflation, and there was a massive big sell-off there. So it's actually broken down below there. Right on support at the moment. Wouldn't be surprised if we look at the RSI. This is a momentum indicator. It's an even oversold region here. Wouldn't be surprised if we do get a bounce. Often when stocks are very, I'll just get rid of this. When they're very stretched from their moving averages, you do tend to get a bounce back up to the moving averages. So this looks like a candidate for a bounce here around this support line. But NAB's the worst performer out of all of them, just in recent times to breach that low from last year, which was a pretty sharp and major low. ANZ obviously trending down as well, but nowhere near its lows from June. This is Westpac, so not too far off those lows, but not there yet. But obviously in a definite downtrend as well. And just quickly look at Bendigo Bank, similar sort of picture there. Bank of Queensland we looked at last week. That's got regulatory issues as well as cyclical and competitive issues. So that's in a decent amount of trouble there. And Macquarie Bank, completely different global bank, operates. I always look at Macquarie as a bit of a sign of global liquidity, and it's holding up at pretty high levels, but it's not. It peaked here back in January of 2022. So it's moving sideways, but it's a long way from its peak. And this is just the ASX 200 banks index, and sort of an arbitrary line around where support is here, but it's broken below there and sort of approaching that major low from June 2022. So all in all, you could say the sector is trending lower. But what I wanted to chat about today was more from a valuation perspective, and just to see when we talk about what's priced in, is this bad news? Is the rising rate environment, is that priced in, or is there potentially more to go? So I might just focus on Commonwealth Bank first, and by doing that, I'll just bring that chart back up. The reason why I want to focus on this first is because it's by far I guess I'll just say it's by far the most expensive Aussie stock there is. So if you look at the numbers, and I'm using financial year 2024 forecast for these numbers, profits are predicted to fall a little bit next year, right? So the market's saying that 2023 was a peak in profits or profitability. Return on equity, which is always a good indication of bank profitability, predicted to be 14.1% for 2023, and it's going to predicted to fall to 13% next year, so slightly down next year, and that still puts it on a PE of 16.4 times. Its yield is 4.55%, and it's on a price to book value of 2.14 times. So when you look at bank valuations, I always look at price to book and return on equity, and those two metrics are closely correlated. So I'll quickly run through the other stocks to give you an idea. NAB's price to book is only 1.24 times, and its return on equity is 11.4%. Westpac's price to book, it's below book value. It's 0.94 times book, but its return on equity is lower. It's only 9.4%. And same with ANZ. It's on a 0.94 times book value, and it's a 9.8% ROE. So Commonwealth Bank is clearly almost double the value in terms of book value than the other three banks, yet its return on equity is only 13% relative to NAB's 11.4%. Now, I don't know the specifics of their book and their credit risks, so that there could be a bit involved there. I know CBA is considered to be the best bank, safest bank, all that stuff. But in my mind, CBA is quite overvalued. And if you look at global peers, so for example, Wells Fargo has a 10% ROE, but a price to book of just 0.86 times. So it's less than book value. It's got a 10% ROE, and it's trading on a PE ratio of 8.56. JP Morgan has a forecast return on equity of 13.4%, and its price to book is 1.3 times. So if you look at CBA, price to book over 2 times, JP Morgan, price to book of 1.3 times, and JP Morgan's got a higher return on equity forecast than it. So I don't think, when we're talking about what's priced in, I don't think reality is priced in. When I do a valuation using an 8% discount rate, my number is around $85. So we're looking at about here for a fair value for Commonwealth Bank, which, that's $10 difference to what it is now. But what the other thing that isn't being considered here, I'm pretty sure I might have it in this chart pack here. So the bad and doubtful debts charge over here for the major banks, all throughout this period here, you've had a decent bad and doubtful debts charge. And bad and doubtful debts spike up in times of economic weakness because obviously more loans turn bad and they've got to make provisions for those bad loans.
Yep.
Post-pandemic, bad and doubtful debts have actually contributed to profits because what they provided for previously, they didn't need to actually write off. So they've written back some previous provisions and increased their profits on that. They popped up a little bit recently. But in terms of the cycle, if we're going into a slowdown, those bad and doubtful debt charges and provisions will pick up significantly. And I'm not sure if the market's pricing any of that in. I just think that's something that hasn't been considered at all, and that can have a big effect on earnings and dividends as well. So that's something that, as we move forward in the economy and as things continue to slow down, if the RBA keeps hiking or keeps interest rates high, I think banks are going to find that they're going to have to make higher provisions, which is going to reduce their profits and profitability. And just using Commonwealth Bank as an example again, banks are cyclical, and the last time the cyclical peak occurred was back in 2018, and that's when it had a return on equity of 14.1%. During the pandemic, its return on equity fell to 10%, and then it come back up to 14.1% in 2023. So the time to buy banks, really, if you're patient, is to buy them when their provisions are rising, when the economy's slowing, and potentially they're having to raise equity. They might be cutting their dividends a little bit. It feels like the worst time to buy, but it's the time you actually should be buying for the next cyclical upswing. And I'll quickly show you why that's the case, because I've got some longer term returns here for the banks that I think people might find interesting. So this just shows the big four banks and their price performance over the past 5 years. So that's really from 2018 until now. Only the Commonwealth Bank has actually done well, and it's had a capital growth of 39, nearly 40%.
Yeah.
NAB is underwater after 5 years.
Wow.
Obviously, if you're receiving the dividend over 5 years, you're still getting a dividend from that. But from a capital growth perspective, you've had none over 5 years. ANZ's actually worse. It's down nearly 15%. And if you invested in Westpac, you're probably still underwater after your divvies. So it goes to show that buying at the wrong time of the cycle for banks can be quite
disastrous,
not great for your investment returns. And even if I push this out to 10 years, it doesn't look particularly good. Westpac's down nearly 30%. ANZ's still down 15%, and NAB's down 6%. The only stock that's done well over 10 years is Commonwealth Bank. So, banks make a lot of money. They generate huge net profits every year. They're always in the paper about how much money they're making. They pay out, good dividends, but they're not necessarily going to deliver you capital growth unless you buy at the right time of the cycle. And the only time I've ever recommended banks is soon after the COVID crash. And I think at the time I might have recommended NAB and Westpac. And that was only for a short amount of time. And I think we captured some of this rise, some of this re-rate up to about here. And might have exited the stocks around there. I can't remember the exact detail. But banks are really for buying at the bottom of the cycle. And you can say that about just about anything really. But this is just to illustrate that the long-term ownership of banks doesn't necessarily deliver you capital returns or capital gains.
Which is interesting, because I think the big four banks loom large over the Australian investors' imagination. It's sort of
absolutely.
But when you really look at the long-term performance, it hasn't been that great. And I think it reminds me of something that you wrote for your monthly in the Fat Tail Investment Advisory, which I recommend everyone to sort of check out. And you said, when you're investing for income in the stock market, you're still investing in the stock market. It's not like you can just go out and buy a company and automatically expect to receive that income yield. That income yield isn't like a bond where it's fixed. It's fixed by the market, and the market fluctuates. So if you see a juicy dividend yield, it's not set in stone that it's going to be like that in a year or 2 years, especially if the stock craters 10 to 20%.
Absolutely. What the market can give you in income, it can take away in capital. So, which is why I always just focus on valuations. And when you focus on valuations, and I always also look at charts and make sure the chart and the fundamental and the technical story are telling the same story. So, for example, I'm getting interested in the banks. So like I look at NAB, and I think, on a forecast ROE of 11.4 times, and it's trading at just over book value, using an 8% discount rate, which is roughly the return that you want to get long term from a investment. NAB looks pretty interesting, but the chart is not conducive to buying in. Like, we might have a bounce, might have a short term bounce, but that downtrend looks pretty well entrenched. So I don't really want to buy into a downtrend, because, as I said, we might have a cycle where bad and doubtful debts have to increase. That will affect the equity and capital base of the company. Some of these banks, if it gets bad, they might need to raise more equity, cut their divvies, all that sort of stuff. So you need to be careful when the cycle is slowing. But yeah, I mean, that's some of those valuations are interesting, but I would say Commonwealth Bank, it's really trading on its history of being the best bank in the sector. And at the moment, not that I wouldn't continue to bet on that continuing to happen, but I just think, the return you get is based on the price you pay. And at the moment, Commonwealth Bank, I'm guessing, based on those comparisons with JP Morgan, which is meant to be one of the best banks in the world, Commonwealth Bank would have to be one of the most expensive banks in the world.
Yeah, and I think you sort of mentioned the bad provisions. I think in the latest ABS National Accounts data, I think interest paid on mortgages grew further 11.5% during the quarter. And now the amount of money being spent servicing mortgages has doubled in the past year. So the key customers of the big banks are definitely struggling now, and they will definitely struggle more in the months ahead as more variable rates roll over. I mean, fixed rates roll over. And I think there was already a headline in the AFR about the Westpac chief, and he was saying, we've been getting a lot more calls to our helpline. And then he quickly said, but they're just calling to sort of check, just to maybe plan ahead. It's not actually at the moment correlating with bad debts, but he's sort of maybe laying down the foundations that, something bad is going to happen down the track. But I think maybe
it's a good leading indicator of what's to come. Right?
Yeah, exactly. I think maybe just to tie everything off, what do you think is the biggest risk? I think, just to conclude, to wrap it up, what's the biggest risk that markets aren't pricing in for banks? Is it just that they're valued too highly? They're trading on their history instead of the looming future?
Well, I just think it's interesting that Commonwealth is that the valuations are at such a disparity with the other three. The other three look like reasonable value, and you'd say, okay, well, that's not a bad play. Again, I'm not a bank analyst. I don't look at the specifics of their lending and where those risks might be. But it seems to me that in those other three banks, the market is pricing in a reasonable amount of risk in terms of the outcome. With Commonwealth Bank, it's not pricing in that risk at all. But overall, I do think the biggest risk to the banks is the RBA. And the RBA has pointed out in its statement on monetary policy every couple of months when it releases it, that it is shrinking. The balance sheet's going to shrink. It pointed out, I think it was the February statement, that there's about $84 billion to roll off of that term funding facility, which equates to around about 15% of its asset base over the course of 2023. And so the flip side of that is that all 84 billion worth of cheap loans are going to reset into the higher variable rates. Banks will need to finance those loans with higher with higher borrowing. So they're obviously going to go out into the market and try to induce depositors to deposit with them so they can finance those loans. The question is, what's the margin they're going to make? Will the margin be the same, or will the margin be tighter based on the fact that they're probably going to have to pay more for their loans and they're probably, for their borrowings and the loans that they're making. There's a limit to how much you can reprice those how much the variable rate can rise before people just start to feel pain, and they're starting to feel that pain now. But in terms of the banks, I reckon what we should do is just keep our eye out for magazine cover indicators. Definitely banks. Banks are no longer the safe,
the safe haven,
safe haven that they used to be. Once you see those sorts of things, that'll give us a sign that it might be time to buy.
Yeah, great. Well, thank you for joining. And as always, if you've enjoyed this episode, like and share. And we do read the comments. So if you have any suggestions or feedback, please do drop a comment. That'd be nice. It's great to chat with you, and I'll see you next week.
No worries. Thanks, everyone.
See ya. Thanks for joining What's Not Priced In, your weekly source of unique ideas in the Australian stock market. Now, if you've enjoyed this episode, please show your support by liking and subscribing, and turn those post notifications so you don't miss a thing. And stay tuned for the upcoming episodes as we delve into new topics, new trends, and new stocks. Thanks for your support. Hope to see you next week.